For someone who's interested in, let's say, diversifying outside of the market, investing in a commercial property and do it the right way, do it in a compliant way. You could argue that I'm like sitting down with the Chicago Bulls. We got Pippen, we got Jordan. I guess that makes you Rodman. So this is legendary.
I feel like Chase could be a pretty good Rodman because he has been so scrappy during the pandemic. He's getting these rebounds and closing like little, $900,000 deals and just keeping us afloat.
That's true. I will crash the boards. That's a fact.
And he's got the best hair like Rodman did too. So
touche, right?
I ain't buying it though.
So I'm excited to catch up with you guys because we haven't talked in a minute. All sorts of fun stuff. I think it'd be really interesting. I asked Chase this the other day, but to get like some of the themes that came out of all your virtual recon meetings, like were you hearing the same things over and over? If so, like enlighten me because, I don't have nearly as much breadth and depth as you guys do. You know small players, huge players. You're seeing so much because you guys do so much. And I guess for anyone watching or listening to this, give us a sense of how much volume you did last year and like just career wise, because it's a staggering number. Like when I'm joking about the Bulls, like arguably you guys are the de facto team of multi-tenant retail in probably all of Arizona.
Well, thanks. And Jesse, I think you should probably take that one. You're good on pitching us as a team.
Well, yeah. Obviously last year was a tremendous year. Our team grossed well over $2 million in commissions, and we, had a lot of success, a lot of repeat clients in those closings. And I think, this year we've seen a drastic drop. Obviously, before we hit the pandemic, we had 8 deals in escrow. Once the first kind of 48 hours of the pandemic hit, we quickly lost 6 of those deals. Not only were we losing deals that were not non-refundable yet, we were losing deals that were fully non-refundable with $100,000 at stake. We had exchange buyers bailing, willing to pay taxes. So it was a really quick knee-jerk reaction once that initial pandemic hit. Now, since then, the knee-jerk reaction kind of calmed down a little bit. People saw what was actually happening. Still wasn't great news, but good enough to get some activity back. We've kept 2 of those deals afloat still with extensions and trying to get creative with seller carrybacks because traditional financing is just incredibly hard to get right now. And if you can obtain it, it's most likely full recourse and lenders are requiring a substantial amount of reserves. So, we did put 4 additional deals into escrow during the pandemic. We had a couple small closings in the pandemic. Have yet to really close anything over $2 million. We've got, got a $9 million deal afloat right now that's supposed to close by July 15th for an exchange buyer. But they've had that's one of the strongest buyers in the country, and they've had a really hard time getting decent financing. Lenders that would come to them with commitments 7 days later would come back to them with additional requirements, whether it was full recourse from partial recourse or additional reserves or whatever it was. And, this week more than ever, we're hearing this, well, if there's a second wave, what good is a seller carryback going to do me? 3, 6, 9 months out, I think lending could be even more difficult as what I'm hearing from buyers. So that's another challenge that we're facing. So, our team has still been extremely active. We're taking deals out to market. We're taking national single tenant deals out. We're taking multi-tenant deals out. But yeah, it's the buyer pool is.
And now we're actually showing up to work every day because I think some competitors have literally talked about how much they've just stopped coming to the office or stopped working period or taking golfing or just taking the summer off. And there's still plenty to do. Like Jesse said, we've got, we're on our way to sell our 200th, property in our careers this year. And I think even though it is slower, we're going to find a way to get there because we've got, like we said, like Chase is, scrapping some stuff together. It is about some hustle and still finding those things because there's still some motivated sellers and there's still some, motivated buyers that haven't exchanged or still find they still have capital in place through their partnerships. So we're finding that, these last couple of weeks, especially, we've seen some new LOIs and some activity that we're happy about. There's
it is challenging, but to Steve's point, the deals that are getting done by sellers that are understanding the situation, understanding what buyers are going through, what lenders are going through, and are willing to give more time than they normally would to get a transaction closed. Not playing hardball when they don't need to play hardball during an escrow. Mm-hmm. Those are the deals that are getting done. The hot-headed, super intense sellers, they're gone right now. They're not selling anything. So they're just taking my deal off the market. I don't want to deal with this. The sellers that are motivated, and not only are motivated, but they're willing to work with buyers, whether it's with some kind of seller carry or with extensions or somewhere in the middle. Those deals are the deals that are getting done. So
break down that seller carry for me for just a second. Is that on a free and clear property, or are they doing a second position or unsecured? And like, how much would that be? Because all of a sudden I've got an appetite for that. And then on the buy side, that's appealing to get in because you can juice your cash on cash return numbers even better. So what are you seeing requested? And
that's a really good question. And we've got two good examples for you. So Steve, why don't you start with Pierce Plaza and then I'll roll into Legacy.
Well, and then we've got Fairway too that Chase did.
Yeah, that's right. Right.
So Pierce is Pierce Plaza. We're doing 50% loan to value. And the reason for that number is really seller driven because they do have a loan, they do have a partner. The partner wants to break clear from it. So when you take in paying off the partner, paying off the lender, which is a relatively small loan, and paying commissions and closing costs, that's all they could give. And that worked out. And they did a 1-year note with a 1-year extension at, I think, 5% interest only. And then Chase, you've got your example with Fairway.
Yeah, so Fairway out in West Phoenix is a little different scenario. Buyer didn't even reach out to any lenders to look for any sort of financing options. He's really high leverage buyer, so he was able to knock out 80% LTV on this deal. 5-year loan, interest only, no prepayment. So I think back to Jesse's point, if you got motivated sellers who want to sell their property, that's one way to get really creative with motivated buyers right now. Kind of a win-win for both parties.
Was there an origination fee on that Fairway deal? No.
And nor with Pierce.
Nor with Pierce. And that's big. That's something to think about too, Sean, when you're, if you guys are looking for seller financing, that's, although the interest rate's obviously going to be at least 100 bips higher of what you can get in the market. You got to take into account in your underwriting no origination fee. That's
and seller carriers are often interest only, so you don't have to worry about amortization costs. There's no appraisals. If you don't want them,
it keeps the cash on cash.
But usually most of these sellers don't want to do a very long term thing. So.
Yeah, and the one I'm working on now, Sean, the property is owned free and clear, and the purchase price is $9 million, give or take. And, the seller is willing to offer a $5 million seller carry. The buyer's not sure if they're going to take it yet or not, because they've got a couple lenders that have kind of one foot in the water and one out.
Yeah, we'll see.
But I think it's a great option because it is, like Steve said, it's IO, and, they'll probably start with a year and then with the options to extend after that. But if I'm the buyer and it's truly just a financing issue, there's no, in this situation, tenants are paying, tenants are open, the shopping center is thriving. If I was a buyer, I would take advantage of that. I really would. And then, if it's 2 months from now, if it's 5 months from now, if it's 8 months from now, and you want to go back out and place some debt on there, could be some good options, or you extend. So, I see that as a win-win. This particular buyer doesn't see it that way yet, but we'll see what happens. We'll find out here shortly. They've got their exchange come to do, so we'll see what happens.
Any other themes coming out of all those meetings that you think are helpful for me to think about, other investors, folks that would want to partner in on deals with us?
Yeah, I've got some stats here, guys, from our summary here. So, we didn't do a strict survey, but we did ask a lot of the same questions. And so we did get some themes here. We did ask about April and May rent collections during the pandemic. And the average collection for April was 65%. And in May, it was 64%. And some of these are big national REITs and landlords that have 1,000 tenants. Some are just have maybe 2 or 3 properties here in Phoenix, but all multi-tenant retail. The lowest was 50 and the highest was 95%. One thing that definitely came up a lot was that the PPP loans clearly helped with May rent collections. Because when we were asking people back in March or early April, like, hey, they're like, whew, all right, we got April's rent, but man, May is going to be tough.
Really worried about May.
Yeah, I think the PPP loans were clear. Not many people lost tenants though, like fully just lost them. And if they did, they were already weak to begin with. But then we did talk about the future and kind of where things were going and what their buying appetites were. 66% thought cap rates will go up 25 to 50 basis points. 25% of the clients thought it would stay flat. One client thought they would go down, and then the rest they just didn't even know yet. And 63% of them were not buying or not buying yet. But the rest, 37%, were ready to make offers now, but with maybe stricter criteria. I think there was definitely a theme too, where some people thought, well, is there going to be a COVID discount for for properties going forward? Is there going to be distressed opportunities? They're just patiently waiting for those things to come along if they are.
So great segue. Let's unpack that for a minute, because we know there's going to be tenants that don't make it through this. That's going to change a rent roll. That's going to change vacancy. That's going to give, tenants that are looking, more options and arguably more leverage. So, play this out with me, like a couple months down the road or later this year, like, are there going to be better opportunities? It's felt very almost frustrating, seller's market up until maybe just recently. And now, like, is there going to be able to be even more compelling deals than there's ever been? And what does that look like? And how does it come to fruition? And how do we get more amazing deals put together?
Chase, you want to take a stab at that?
Well, my first thought is, one of your questions, Sean, was, when would you buy? I mean, I still think there's opportunities today, right now, that could present themselves as a good buy. It doesn't necessarily have to be picked up at a huge discount to be a good purchase. I think, there's irreplaceable real estate. We got a couple deals in escrow that are just like that.
I can think of a great one in Tucson.
Exactly.
With 4 tours coming up on the vacancy.
That's right. But I still think right now there's opportunity out there that will present itself. But yeah, I mean, as far as when, I mean, we've been hearing kind of Q4, closer to the end of the year, we might start seeing some distressed opportunities, if you will. Jesse?
I think Q4 would be the soonest we see them in terms of actually any kind of REO, fresh REO deals, because it takes a good 6-9 months to get deals, to that process. It's an absolute cycle to actually become REO once tenants start failing. So, things really hitting the fan, like, late March, the trickle down effect, you're already Q2. I think you're really looking like, Q1 of 21 or Q2 of 21 is really when you'll start to see the high distressed demand. And I think once those deals hit, the amount of buyer demand is going to be unbelievable.
Yeah.
You're going to have buyers that have just been waiting for this moment for a long time.
Okay.
So that's
one of the number one questions we're hearing right now.
Yeah.
What are the opportunities?
But let's do a little fire round here. We can go one by one. Like, if you guys are going to place $1 million, a couple $1 million, whatever it is, you've got one shot to buy one deal. What are you looking at? Like, what's your personal favorite? And that's a personal preference thing, right? Some guys' risk to reward ratio is going to be bigger. Maybe you want it to be in, a place with a sexy name or a sexy tenant. So like, I think it's fine for you guys all to have a different taste or appetite for that. But I'd be curious personally what you're hot on.
Me first, all right.
Steve, maybe Steve, you jump in first.
All right. So I obviously, look, I sold shopping centers and I'm biased, right? But I mean, I still like the 10,000 square foot strip center that is 75% leased, because that means you just got to do, but it's still in pretty good shape. I mean, it's not like a dog. You need to do like 2 leases, 3 leases, and you could sell it for a profit or just keep the cash flow going. I would seek something that's got rents, no more than 20 or 25 bucks a foot. And, cause like, I don't have the patience myself to probably redevelop a property, completely reinvent it and, tear it down and build it back up again, sort of thing. So I think it seems like low hanging fruit, but if you could even buy it at like a, 6 or 7 cap in place, and then you do 2 or 3 leases to 100%. And all of a sudden you're at,
10 cap,
you're at a 9 cap or whatever, 10 cap. You can cash flow that thing for a while, or you can sell it and probably make a few hundred and go on to the next one. So that's what.
And that's probably hitting a double. I mean, I love doubles. People like doubles. It's not a home run. It's not a triple, but it's enough to get excited about.
Is that the move right now? Like, don't go for the home run, like go for more of a steady Eddie double. Jesse, you going for a home run?
Yeah. I mean, home run opportunities are obviously incredibly hard to find. One, I don't think they're there yet. 2, but I'm with Steve. I mean, I kind of think that sweet spot is like 65% occupancy, because the chances in Phoenix where you can still get a decent cap rate, might even be able to still get debt and not have a negative spread between your cap rate and your interest rate.
Yeah,
I love that number. I mean, if you can get a 6 to a 6.25 cap in place on 65% occupancy, have upside. That upside, if it's vanilla shell, beautiful. If not, underwrite it accordingly. But I think that's what I would be salivating on. And those opportunities are going to be there. Those are going to be there sooner than any REO opportunities. There's no question.
Is there going to be a sweet spot for budget where you're like maybe a little out of reach of like a mom and pop first time investor, but like you're not competing with the big boys yet?
Yeah. I mean, I think that number is really kind of, like 7 million and under, 7.5 million and under, around there. I think once you get above there, you're going to be seeing, like, when for example, we took that Awatuki Mercado deal to market, and it ended up selling for 9 million, 64% occupancy, and that was shadow space to a Safeway and Awatuki, really clean deal. We had a dozen offers in 2 weeks on that deal. And it was an institutional seller, Trigate Capital, institutional buyer, Westwood Financial, but we had just a slew of big boy players at that $9 million number. So I think, that range, it definitely can become an institutional play.
We talked about 7 million before. We had kind of a weird stall out on some deals in that range because there just was, it was too big for some small exchange buyers and too small for the big institutions.
Yeah, kind of a tweener.
All right, Chase, we want to hear from you too. What do you like?
Yeah, well, I think I'm going to echo both those comments. Honestly, I like the unanchored strips where you're not, encumbered by any neighboring parcel owners. No sharing of CC&Rs or any kind of regulations. I would really put a strong focus and emphasis on population density and traffic counts. I think those are 2 of the most important fundamentals for any investor, new or seasoned, to focus on. The more foot traffic and car traffic you can drive to your center, the stronger it's going to perform.
All right, you guys have seen people hit home runs. You've seen people screw up royally. I'd love to hear, some of the contrast between those 2 experiences. How would you mitigate risk? Maybe aside from the pandemic, and now it's probably just a little bit more exaggerated. So what are some things that I should think about? Anyone buying retail should think about, and folks investing in deals like that.
It's just luck, Sean. That's all it is. Just luck.
Vegas. It's Vegas.
Some punk ass kid could buy a deal in Maricopa and change his entire life. You never know.
But it's funny because look, we kind of remember the recession, right? The 2008-9 time, and when it was happening, it was scary, right? And like everyone knew there were opportunities, but they didn't know how long the crash was going to last. And do I buy now, or do I wait a couple of months? Do I wait a year from now? When's the right time to jump in? And it started crawling back up. Did I miss them already? Like it was so hard to time things, and things were scary. And Jesse, I feel like I might steal one of your stories, but like the Shea deal, right?
Oh yeah.
I mean, right, because like that was a deal where we had. It was a distressed asset. It was a loan sale. But we were basically selling it like it was the shopping center, because the foreclosure was, a month away, sort of thing. And, we had, we had about 10 offers probably on it, it seemed like. And there were like the top two guys. The guy in second place was like, gosh, I just don't know if I can come up with that extra $25,000. And the guy that bought it made $1 million on it in about 18 months. So it was like you didn't know exactly how it was going to go, but we look back at that and we're like, man, you should have bought everything. I mean, hindsight's always 20/20, but in the moment, that second place buyer was scared, that it could keep going down, or what if it doesn't come back? What if things don't
fix? Let $25,000 get in the way of a home run is the moral of the story. And when that deal closed, the e-blast went out and he forwarded me the email and just wrote, thanks. Like it was my fault. And I wrote back and I said, Mr. Client, I told you where you had to be, which already was over the line for me to say. So we since have kissed and made up, and I've sold 5 deals for him since. But to hit a home run, you can't let $25,000 get in the way of that. I mean, you gotta swing harder than that.
And that was a home run, because you know that, and again, for anyone who might watch this, that this is like the stuff in like the Instagram things and in the commercials or whatever else. I mean, real estate is not a quick, buck sort of thing. I mean, it takes time, it takes work, it takes a long time. Most of the deals, that were bought, I mean, it's patience, it's hustle. I mean, it's like most of those deals isn't just about them. I mean, there's a little bit of luck on kind of what shows up at that time, but you got to work them. I mean, every other store we've got is more of a long term thing. One thing I did want to comment on, I remember back when the recession came into play, we were kind of peaking in the last run. Some guys, our clients from Bozeman, Montana, they always went, they're always doing the 1031 exchange, right? Always do that next deal. And they were so motivated on that, even though they saw the market might be changing and they didn't, know where things were going to go. There was some uncertainty. They still went through that exchange because they were so hell bent on not paying property or paying, capital gains taxes, that they bought that next deal. And I remember them telling me, 2 years later, after they lost that next deal to the bank because the market had crashed, like, I wish I would have just paid taxes. So don't let that exchange and reinvest that money, make you do something stupid. So,
well, okay. So let's break that down just really quick. What led to that challenge or demise was it over leveraging? Was it, buying at an absolute premium? Probably a combination of the two, a little bit more conservative loan, more capital reserves. And, are we solving for that? They could weather the storm at that point.
Yeah, that's exactly. I mean, because that's what a big part of what put both residential and commercial into that recession was over leveraging. Houses were being loaned on at 100%, and you could do a shopping center at. I hope Jesse's frozen. Otherwise, it's really funny. We put him to sleep. But it was it was over leveraging. So I mean, if you keep it safe at 60-65% LTV, you can weather the rough times like COVID and pop your way out of it. Okay. So,
I'm sure Jesse will jump back on in a minute here, but you guys have probably seen more of this than anyone I know. And so I'm really fascinated to get kind of your collective take on it. But, apartment buildings are easy to wrap your head around and grasp. People get single family rentals as an investment vehicle. People are familiar with the stock market, probably a lot less so with retail. So I'm curious, why do you think your clients invest in maybe this lesser known, lesser understood asset class versus all the other options? And, even in light of like some of the headlines that you might read about, why do they continue to do it? Or why do you think that they will? Like, is there something that they're seeing in this category that maybe most of the world or investors isn't as familiar with or doesn't see? Like, what is it that's attracting them fundamentally to what it is that you guys work on?
Well, I mean, you're seeing less competition. No question about that. So, I mean, our multifamily brokers, I mean, they're still seeing 25, 30 offers on every listing. We're not seeing that in the retail world. And
that translates to what? Better.
I mean, the odds of buyers getting a deal is slim to none. I mean, you really
higher return.
Oftentimes you're having to bid well over what you were willing to pay just to get the deal.
So they're having to stretch on price. That asset class already has, tighter cap rate. And so there's just, if you compared those two asset classes, multifamily and retail, like, what do you say that cap rate difference is?
200 basis points right now.
Yeah, 200 to 300 basis points, depending on the asset. And I think the other benefit, what some retail investors are seeing is, a lot of the shopping centers out here are essential services. Consumers are still coming out here and going to physical retail stores. I mean, all four of us here could say that we go to the grocery store, the barber shop, girlfriends and wives are going to the nail salons, and we're all experiencing it. So I think, and a lot of the deals that we've closed recently and are working on right now haven't been, terribly affected by this. And a lot of the tenants there have still been doing well throughout all this. So I think it's easy to get wrapped up in the headlines, but at the end of the day, a lot of the retail out here is essential and going to be essential for foreseeable future.
Mm-hmm.
Yeah. I think it's obviously the return is one thing, right? I mean, you do have these longer leases, but it costs more to get the tenants in there, and the turnover costs are higher. But a lot of our clients, I mean, they know, and they've always known and worked in retail, right? So they go to what they know. They know their players, they know how that works, and the ups and downs and the pros and cons and what to watch out for and where the opportunities are. But I agree. I mean, it's like, although people may understand an apartment complex a little bit better, I mean, really, everyone kind of understands retail in some fashion because we use those things. And yeah, we've been fighting the headlines and the bad news for a couple of years with, the department stores and the malls are dying and Toys R Us bankruptcy and this, and those things are very headline worthy because with it all places we know and go to. And so they really affect things. But again, back to, where our specialties mostly lie is in kind of neighborhood strip centers. We're not really dealing with the full size malls with our clients much anyway. So to Chase's point, there still is definitely categories that will need to exist in these properties. And sure, there are some categories that are gone, and now we're fighting the internet. Now we're fighting viruses and so forth. But I think people will come back to this trend of continue to shop and spend in. People want to be entertained. They want to go to restaurants. They need to get their haircuts so they don't look like Sean.
Steve, what were the stats that you had for me the other day that were really good, where it was like big box retail was down 100% from the pre-pandemic, and single tenant was down, I think, what was it, 50%? And then what was the neighborhood number?
Yeah, and that was those numbers. Yeah, this was someone
broker had them.
A colleague, or I guess a really competitor of ours, was saying that as far as his business flow got affected, and the single tenant triple net property sales seem to have stayed fared a little bit better. There's been more of those sales going on because they're mostly cash and long-term leases. But it's still, his business is down about 50%. But then if it was a multi-tenant center, his business went down like 80%. Then if it was a large big box anchored, $20 million center, that his business was down 100%. And it was all during the pandemic because every buyer kind of froze in place for the moment and just to watch what happens. I mean, we're the three of us are a little more optimistic than some of our competitors, but I mean, my feeling is that by the end of the summer, we're going to start feeling pretty normal. We already do kind of in Phoenix as far as just shopping and restaurants and so forth, but we're going to feel pretty normal with some buyer and seller activity, by the coming into the end of the year. So
Yeah. I mean, what you guys brought up is probably largely the reason I was drawn to this in the first place. And it's, for those maybe on the outside who haven't done deals before, it can be intimidating. It can be scary. There can be a learning curve, but that gives a little bit of a barrier to entry so that you can enjoy those higher cap rates and potentially 50% higher, cash on cash returns in some of these deals that, arguably are some of the best tenants in the world. You think about, a McDonald's or a Starbucks on your rent roll. And, I had a lot of confidence that those folks are going to pay the rent. Maybe pandemic made it a little bit exciting, but generally speaking, if you think back about the last decade, like that's been a pretty safe place to play. So that's interesting. Do you guys feel like there are any big misconceptions or misnomers or like myths that you think are going on either right now or just kind of at large? Like you hear it and you're like, that's just generally not right. Like things that maybe I should think about or other folks investing in this asset class.
I mean, we've been saying it, obviously, aside from this time, because the retail apocalypse, like the same thing we said before, is retail is not dead and it's not going away. It's not they're not going to just demolish every shopping center, so it still has its purpose, and I think it always will. And, you think about, every product type changes, right? I mean, apartments, now you need to have all these amenities to compete with the guy across the street.
Right.
And office buildings need better parking ratios because they're doing, who knows if it'll change.
Different build outs. Industrial buildings need higher clear ceiling heights. So the ones that built, 25 years ago are no good anymore. But like everything just kind of changes and evolves and you just kind of get up to it. So this is what's happening with retail right now too. It's going to have a little bit of evolution in certain categories and designs, maybe become less functional, but it's not a dying property type. Yeah.
Agreed.
You wouldn't have 50,000 people signed up for ICSC if it was a dying property type. It's just not going to happen,
It'll be interesting to see.
Drives me crazy.
Not just like the demand for the conference, but just like when people are kind of unleashed, like how much pent up demand is there going to be for a lot of these things will be fascinating.
Yeah, it's like
I surprisingly miss Vegas.
And how crappy like the food is when it comes to you, like cold in a box, opposed to like being in the restaurant with your wife and having a bottle of wine and a cognac and having a hot bowl of pasta. Like that's, it's just night and day. You can't tell me that you wouldn't rather be in a restaurant away from the kids, with a candle lit, somebody daunting on you, no dishes to do, no boxes to throw out. Shit, my garage looks like it's unbelievable. It's just like, I can't even park in my garage. So many damn Amazon boxes. That's no way to live.
It's a part-time job now, breaking down Amazon boxes.
I was going to do like 4 times. I'm not even kidding.
And there's some things that I just did that I think people will trend the other direction with internet sales. Cause like, I don't like buying clothes online. Yeah. I've tried it. It doesn't fit. And I hate returning crap. It's just a pain in the ass. So I think, and then you saw that. There's a lot of, before COVID, all of our talk was about, retailers and the internet, and more retailers that are on the internet want to have brick and mortar physical stores because they need their brand out there and people want to try things out.
Increases their sales.
Customer service. Again, they're changing their business models. And so, oh no, Amazon's, into the grocery store world, like what's going to happen? Like everyone's going to get their groceries delivered now. Oh, guess what? Amazon's opening up grocery stores. Physical brick and mortar grocery stores that you walk into. That stuff's just not going away. People will find what works and what doesn't, and then they'll stick with it from there. So,
yeah. Do you want to go to Steak 44 and get a steak to go for $50?
Doesn't make sense.
It doesn't make sense.
Experience. Yeah.
Yeah. The Amazon getting into groceries has kind of kick-started it for a lot of other grocery brands too. Albertsons being one of, really figuring out this omni-channel in-store and online works together in a sense. So there's a silver lining to that.
Dude, you guys are awesome. I appreciate you sharing all the wisdom and the insights. If folks want to reach out to you, what's your favorite channel? I mean, Chase, you're probably on TikTok, but what's the best way to track you guys down?
100% false.
Find us all on LinkedIn, and that's probably the easiest place to start.
Just Google us. Steve Julius, Jesse Goldsmith, Chase Dorsett at Newmark Knight Frank. Phoenix.
Yeah, Google us, LinkedIn, call us direct. We love meeting with our clients, coffees, lunches, happy hours, whatever it is. I know it's a little tough right now, but once this all subsides.
I would say, having worked with you guys on a couple of transactions now, you are the beasts of broker opinions of value, probably the most detailed, accurate. I mean, I see more BOVs that have come from you guys than probably a lot of folks combined. So just the sheer volume of deals that you've underwritten, for as long as you've done it across, the whole greater Phoenix area is just mind blowing and staggering. So just happy to have you share all that knowledge and wisdom, and very appreciative of you jumping on today, fellas.
Yeah, it's our pleasure. Yes. Steve Julius is the best underwriter in the business, and I tell everyone else to get their own Steve Julius. So
and Jesse's the best salesman in the business, and Chase is the best data cruncher in the business.
Chase is like a perfect blend. He's like a perfect blend. Yeah. Sean, it's good to see you. Really good to hear your voice.